Success in Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network. It's Kerry Lutz with us for our bi-weekly installment, although it's been 3 weeks, is Danielle Park. Danielle, how are you?
Hey, Kerry. I'm good. Thank you.
Great. So what is going on in the world with commodity busts and oil prices staying in the low range here as much as all the king's men try to put Humpty Dumpty back together again?
Yeah, well, I think it continues to be about the glut of supply, and everyone that's optimistic on a rebound in oil prices shows these demand charts out to 2016 where they have a rebound in demand. In other words, they expect strengthening demand. And in that portrait, they, say, well, surely oil has bottomed in here. But I think it's more likely that we aren't going to see strengthening demand over the second half of the year and into 2016. Everything that we're looking at in terms of the macro environment is, just negative and weakening. The 6-month consecutive factory orders numbers this morning declined again, not seen since the last 2 recessions. The world trade volumes continuing to plunge back towards where they were into the 2008-9 recession. All that stuff just really speaks to a world that is in fact in the down cycle part, not in the expansion bouncing back phase. So I think people are optimistic about what demand's going to look like. I think that's going to make the supply glut even worse. We look at things like storage capacity for fossil fuels in general, but for, things like tanker storage, all at premium levels not seen since 2008 when everyone was floating tankers hoping for a quick rebound. Well, back in 2009, they got a quick rebound, right? All the financial engineering that went on in the world, all the monetary infusions brought about this quick rebound in energy prices, but it was short-lived. And, that helped sort of save the bacon for a little bit longer for some of these producers and highly levered, more reckless participants. But I don't think we're going to get that this time, Kerry. I think we're going to be in the old, more like a organic, mean reversion that won't recover until you get some actual, savings built up in the world. And then you have some reason to invest because the macro environment looks promising. I think we're done with the short-term speculation phase here.
Well, I mean, if you look at Iraq now, they're starting to produce record amounts of the black gold, and still, Texas is going to have a record production this year. North Dakota will be down a little bit, but you're not seeing production decline like the Saudis thought it would when they cut prices the way they did. I'm skeptical about production really decreasing at a meaningful rate. So then you're left with demand, and the world economy just is not what people are predicting that it's going to be. Car sales are continuing pretty strong because they're just because the sub prime economy in the U.S. is just going like gangbusters. Anybody that can fog a mirror can go out and get a new car or a recent vintage used car. But how that's helping things, I don't know, because those cars are generally more fuel efficient than cars of older vintage. So where's the demand going to come from, right?
Right. And, the thing that must not be underappreciated about the QE infusions the past few years, about the Wall Street bailouts that took place. Really, Wall Street has worked hand in hand with infusing free or really low rate money into various sectors, the highest risk sectors and the energy sector in particular. So really, we've had these unsustainable business models that were really dominant in the sector because everyone was uber bullish about what kind of price gains they were going to see going forward and that there'd be this insatiable demand. Well, that hasn't panned out. So the only way that this, has limped along the past few years and continued to produce and continued to have record output has been because they could keep borrowing more and more cheap money. And so the two things are really one story here. The bailouts of Wall Street meant that they could aid and abet the weakest businesses to get more highly levered. And so now we're in an environment where, at some point, I remember this in the construction bubble in the United States in 2006-07. I remember it in other periods where, it's the weakest players that are underbidding everyone and have the least sustainable business models, right? But they have the most debt. So they are just, gunning for the fences at all times. And their math makes no sense. But because they can get cash flow, they can keep going, right? That's basically what we've seen in the energy sector the past few years. While everyone was so, uber optimistic and proclaiming the wonder of this sector, the truth was that they were becoming weaker by the day in terms of their balance sheets, in terms of their sustainability. And so, the good part is they pumped out tons of product, which the world is now awash in. The bad part is there's less places to put it. There's likely to be further declines in price because all these desperate for revenue places, and there's tons of them, whether they're countries or companies, that are just desperate to pump out product to get cash flow to service all this debt that Wall Street's helped them handle, throw on the cart the past few years. So I think all in all, it's a very positive leading towards the washout phase that we need. We need to have the speculation come out of the markets to let some price discovery take place. Then you're going to get some sense of where demand actually says price should be, not where the riggers and jiggers want it to be. And then the unsustainable business models will have to consolidate or go bankrupt or, exit the space. And in the meantime, you're seeing so many really exciting things happen in sustainable systems in terms of building large buildings in urban centers, water management. A lot of these things are sort of coming about for the same reasons. They too were able to access, some credit over the past few years. The high oil prices really were a catalyst in the past few years to some of these innovative energy systems and water systems and all sorts of things. So anyway, all that together is really almost for the same reasons, but there's some good coming out of it. Let's put it that way.
Yeah, well, it's the cycle, the commodity cycle. It happens. And the fact that energy prices stayed so high for so long was really an anomaly, because the normal way the cycle works is prices peak and then they stay that way for a relatively short period of time, like usually a year or less, and then they crash. The fact that they stayed so high for so long really was anomalous.
Right. And it was that the cure for high prices is high prices. And in a lot of ways, it was not a normal functioning market space. I mean, even, all the guilty pleas or fines being paid by the financial intermediaries the past few years really just point to the fact that it's been a highly rigged and maneuvered marketplace. So really price discovery has given very misleading signals to producers and people that were legitimately trying to invest in the space. And now we've got all this, wasted capital, basically sunk costs everywhere. And people have no option but to try and keep pumping the stuff out. So anyway, I think I love that clip I put on the Saudi oil minister was saying, in a speech a couple of weeks ago that, in Saudi Arabia, we recognize that one of these days not going to need fossil fuels, and they're starting to look at how they can pump out solar, which is something they actually have more of than oil, and it's easier to access. They just need storage technology, and they can literally pump that out to the rest of the world. And I think the penny is finally dropping there. And so I think America and Canada in particular need to do likewise. We need to look at growth areas that are going to be sustainable and not keep trying to tether ourselves to an antiquated technology, which is really what so many people have been doing the past few years. I get a kick out of, I must say, I as you know, I was speaking at a lot of resource shows in, the 2007, say to 2013, 11, 13 in that area. Because why? Because resources were all the rage, right? Especially in North America. And so conference people who are essentially marketing companies would come in and put together conferences focused on what? Commodities, right? So those were the ones that, like in the 2000s, you were getting asked to speak in the late 90s and early 2000s at technology conferences. In the past cycle, it was commodity and resource cycles. But what's interesting is that all the speakers that were brought in to talk about those themes had to pretty much be bullish of that sector in order to get airtime or get the invitation or be given the podium. And, I sort of being Canadian, was asked in on that group for a few years. But unfortunately, when I came on board in 2007, our macro work suggested that the credit bubble was peaking and the commodities bubble was probably peaking alongside with it in terms of demand. Made sense, right? But every single person that we would be encountered with or paired up with or on panels with were bullish of commodities. And I find it very ironic that many of those same people are today now in interviews talking with, obviously, obviously the peak was back in 2008, 11, and, obviously this and obviously that. And I mean, it just buyer beware, right, to people purveying information, because it's like what you see on, CNBC and Bloomberg's today are typically, bullish of equities, or they won't be asked on because that's the product that's being sold with the greatest margin. So I think you really have to, price cycles are volatile. They can go on leverage much longer than anyone thinks possible. Poor managers and producers or construction companies can exist far longer than anyone thinks feasible if they get access to cheap money. But at the end of the day, it's the macro picture that drives the valuations, and the valuations are really what drives the future returns in something. So price can go all over the place, but if you're paying a premium for an asset or an investment thesis, then you have to appreciate that if you're paying a very high valuation, you're essentially locking in the prospects of poor returns from that point forward. And so it's just counterintuitive, unfortunately, to the way most people look at their money or quote investing. But if you can just realize that, no one's able to call price turns perfectly, and that shouldn't be your focus. Your focus has to be on high probability indicators, which are what valuation are you paying for what asset at what point in time. And if you can stick with, it's boring to say, but the value plays, the things that are unloved and underappreciated at a given time, you're much more likely to find value in terms of return from there than the other way around.
So do you think, Danielle, that the value investors, that the market's going to turn and people will start looking for value plays that'll become in vogue again?
Well, the honest value investors, the ones that have a legitimate valuation discipline that dictates what they can buy and sell, they basically can't buy much in these markets today. And that's the truth. Everybody else is like a bastardized value manager where they espouse a thesis of value, but in truth, they don't have a thesis of value because they have a long always mandate. And that comes from their marketing arm. So back to what's hot, what people want to hear about is always what's gone up the most in the last little bit, right? So unfortunately, that means that all the funds that are rolled out are typically in the hot sectors instead of the bad, the sectors that have underperformed brutally. So you get this exactly at the wrong time inventory of investment products and people pumping them. So I think value is, it's a no-brainer. Of course, value is always going to trump over time. If you pay under, a low multiple for something, whether it's price to sales or price to book, price to earnings, market cap to GDP. I mean, there's a whole bunch of historically reliable tools that we can use. But if the verdict comes back that things are too overpriced to buy, then you have to stick with that discipline and not buy them. And unfortunately, the business doesn't like that answer because that means they can't make, quote, profits on selling people or buying people certain products at any time of the week. week. So the value investors that are in true and earnest and have discipline over time are still around, and I think will come back in spades in this cycle, because we are so insanely valued in most things that this will be one for the history books for sure. But the others who are talking like they're value investors and justifying current prices as if they're attractive, well, that's laughable.
So you think, so in other words, there is an objective definition of the value investor. I guess we could go back to Benjamin Graham, because he's the father of it all, right? And then
absolutely,
then there's everyone else.
Well, there's a lot of, I mean, you don't have to, Benjamin Graham certainly was the father of doing the math behind it and saying, look, guys, there has to be some objective way to assess whether something is a reasonable price for what you're buying, right? And we have those sort of intuitive markers for other things that we buy in human life, whether it's food or whether it's, clothes or whatever it is we consume. We have a sense of how much we think it's worth relative to our available income or capital, right? But when it comes to investing, unfortunately, most people don't have the training or the objective discipline or rule set, so they don't really know how to assess things. So Benjamin Graham certainly wrote the book on here's some tools, here's some ratios that over time have proven to be very reliable. But what he was frustrated too, and I remember reading about this extensively, he came to periods where he just turned his back on the whole, quote, investment business and said, it's batshit crazy most of the time, because the salesman and the salesmanship of it, of the getting people to part with their savings so that you can make a profit on it, that impetus of the industry wants to drive the bus at all times. So it drives right over anything that doesn't appear to be, if there's a valuation block in its way, it'll say, oh, well, let's discount that. Let's come up with a new metric. Let's measure it a different way. Let's not be so dark, that kind of stuff. So Ben Graham himself got to a point where he didn't invest in anything either. He just said, at particular points, he said it's so dangerous and precarious, reckless, and yet widely, it's hard to be bearish when you need to be on a valuation basis because the tide is inevitably, raging bulls, desperate for profits, and they are throwing away everything that is in their way, in terms of stopping them from getting to that goal. So it can be very difficult to be a disciplined value investor. And yet, I think it's the only, if you're not going to be that, quite honestly, you would be better off to go off and, work in some other field that's purely sales driven, that doesn't have any actual negative consequence to people's, life savings or life trajectory. I mean, sell them candy, sell them shoes, where you can be constantly pushing your product and, hopefully you'll find people who want shoes or candy on a given day. But when it comes to investing, it's such a different beast. It is not just product orientated. It's everything to do with risk management. And that's why that's always going to be in constant conflict with the sales machine.
Yeah. I think that's the key, that you're not selling a product, you're selling something wholly different, right? Wholly different than a product. It's got components of an asset, and then there's risk components, right? There's so much more to it than that.
Well, and not financial products are not for every person, and they're certainly not for every person's every dollar. If you're talking about building a solid financial foundation for people, and believe me, I give advice to people often who are not clients, who just write me and say, here's my scenario, what do you think? And I look at it and go, well, you shouldn't even have money in financial assets. You've got these debts over here. You need to pay those off first. Get your house, get your roof paid for, get your savings built up, before you can afford any risk, before you can afford wagering your life savings or capital, get some positive net worth, get a solid foundation built before you start worrying about what kind of curtains to put in the house, So that's really antithetical to the whole model, which is to get people to buy as soon as possible.
Yeah. Oh, for sure. So establish priorities first and invest with specific goals, not just to get rich quick, because then you're going to be a sitting duck for the salesman, if you will, I guess.
Yeah, and the our last client letter was called Theory Wise and Real Life Reckless, because I went through some specific examples, and these are ageless, Kerry. These are with us from when we have books about anything to do with human experience with money. But basically, the theories, the who is the Jeremy Siegels of the world? I saw him on today. I saw his face talking. I never listened to him, anyways. But those people are always espousing the PhD theory, which is always ends up in the same place, which is buy risk assets and you'll get rich. That's because that's who's funding them. That's where they get all their fees, is from an industry that's saying to them, now go say this to these people. But in fact, they're extremely reckless to real life outcomes. And I think that it's very important for individuals to understand that they have to build their financial house based on what's wise and prudent and supportive of their own financial picture first, before you ever get to extrapolating these theories that people are selling you.
Yeah. Well, I think there's a lot of wisdom in that, Danielle. Unfortunately, not enough people follow it. And then they wind up, in a lot of pain and learning very painful lessons. And hey, our goal is to try to help them avoid that, right?
Absolutely. Waste less and save more, and not have to suffer through these lessons over and over and over again. It's not necessary. And right now we are living through one of the greatest manias of our generation of 100 years, the third wild speculative era in 15 years. And this will go down in the history books, and it will not last forever. None of us can know when it will end in particular, but we know that the valuations are insane, that the pressures that are driving things are not sustainable. And we can be so much wiser than that if we just pull back from the maddening crowd and start looking at sustainable systems. And that's why I've been writing a lot about that on the blog lately. Sustainable systems around agriculture, around water, around energy use, which is alternative energies as well. All these things we can do that will actually build a strong foundation for our economy and for our society and our existence going forward. It doesn't have to be all levered trading of wild speculation. That's a complete waste of money in the end. So we can get so much further ahead if we sort of turn our back on that madness that's driven everyone to the brink for the last 15 years and start off in a new venue and a new vein. And I think it's spreading. I really do. I see a lot of evidence of people starting to come to that concept and saying, wait a minute, let's try something a little smarter now.
I think that's a great thing. I hope that many of you wake up to that truth, smell the coffee before it's too late. Anyway, find Danielle's work at jugglingdynamite.com. As always, we'll have a link on our site, financialsurvivalnetwork.com. Danielle, we'll talk to you in a couple of weeks. Be well.
Thanks, Kerry. You too.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.